This is Taking Stock on Bloomberg. I'm Pim Fox. Now, Warren Buffett's Berkshire Hathaway company, well, it's added to its position in municipal bonds. The big question, is it too late for you to add to your position or to initiate a purchase? Let's find out. Richard Ciccarone, he is the managing director of McDonnell Investment Management, is our guest. Richard, thank you very much for coming in. Glad to have you with us.
Glad to be here, Pim.
What is the attraction now, if indeed there is any, of municipal bonds? We went through a huge dislocation in the market, the end of 2008, beginning of 2009. What's the status right now of the muni market?
Well, you have municipal bonds that are still looking very favorable to treasuries, of course, but also to corporate bonds. And I think one of the things that's missed right now, a lot of people are saying, I need fixed income, and they naturally, their first look for a lot of folks will be to look at the corporate bond market. But the yields on those, I was looking at an issue today, a 10-year McDonald's bond. I think it was being quoted today somewhere around $4.95. Now, you look at what's in the municipal bonds for 10-year securities, and even though on the surface it appears rather modest at $4.37, but if you take a look at it on a taxable equivalent basis, you're saying that you have very attractive taxable after-tax equivalent yields, particularly those that are in the 35% tax bracket or higher. And the beauty of municipal bonds right now is a lot of people believe that tax rates are headed higher for good reason. All of the debt that the government has had to take on, we've got to pay it back. And so that if you look at it with what is projected to be the higher rates that are coming up in the future, you're going to see on the 10-year, you're going to see yields of close to 7% for the 36% bracket and well over 7% on taxable equivalent levels for those in the highest tax bracket, which will be 40%.
So let me just ask you, do you think this is a case, though, of, panic now and avoid the rush, get in before the tax rates go up and everybody says, oh, my God, I forgot to get my triple tax-free munis?
I think it is a good time for people to look that way. And those that really want to match up their, want some long-term securities with taxable equivalents that are closer to their target, I think that makes a lot of sense. And in fact, I know a lot of people don't want to venture into long-term bonds because you're expecting interest rates to be higher down the road. However, you look at the advantages of munis on the long bonds where the buyers are not as plentiful. The advantage that I mentioned earlier are really inferior to the 8s or 9% taxable equivalent values you see when you convert those 550s to the new rates.
So the idea is don't be afraid to look out a little bit on the maturity scale.
I think so, and I think some people are starting to recognize it. The fact that recently I'm finding out that unit investment trust business, which has been out of favor since the 1980s, and maybe for good reason. In some cases, its interest rates were very, very low. You're seeing that area being very active on the long end of the market because they're looking at taxable equivalents for some of the highest tax bracket investors, nearly 9%. So I think that we've come a long way, but there's some room there to still take advantage of municipal bonds.
What about the potential for defaults in the muni bond space? I mean, we do get them, and having the government of California come out with its dire predictions doesn't help the feeling of the muni bond market.
Well, it's interesting that Warren Buffett said that it was announced that he's doubled his position in the last year. At the same time, he's been out there with statements when he talks about his bond insurance company that the risk is greater than what is perceived. I think the key here is be selective. Complacency, there's no room for that in any investment. But I think in municipal bonds, they tend to take them for granted. I think as long as you're selective and know what you're getting into, I think that's the key. Now,
all right, now, we're going to continue the conversation. We're going to get into some more details with Richard Ciccarone. We're going to find out muni bond defaults, distressed sectors of the municipal world. We'll give you some details. This is Taking Stock on Bloomberg. This is Taking Stock on Bloomberg. I'm Pim Fox. Distressed muni debt, is there such a thing? What about a government bailout helped by the U.S. Treasury? Well, let's find out. Richard Ciccarone is the managing director of McDonnell Investment Management. He's my guest. We're talking about municipal bonds. First, let's talk about the possibility of the federal government coming in and maybe guaranteeing muni bonds in distressed municipalities. We've got a Build America bond program that's supposed to jumpstart muni bond issuance. That's happening. is the possibility that the government will step in?
Well, Congress is exploring several proposals, two of which do provide some sort of backstop protection for municipals, either on the short term or a reinsurance agency. Don't know how far those will go. They keep being brought up, though, and there's been a request to the Treasury to provide some support for California, which we know have some serious cash flow issues. The concept of the federal government getting involved in bailing out municipals is sort of foreign to me in a sense that we have a good public finance system in this country. And we've prided ourselves on the state and local governments should have balanced budgets. But when you start to provide federal backstops, even though there is some need right now, I think you get into a slippery slope in which then it's going to be very difficult if you keep providing liquidity and capital to governmental bodies through the federal government for them to make the kinds of cutbacks that are going to be appropriate for the economic base as well as what the taxpayers can afford. So once we go in that line of providing that capital access and liquidity, I think we've got some other consequences that we have to deal with from fiscal prudence from state and local governments.
All right, let's turn the perspective then and talk about it from an investor point of view, because you just mentioned don't be afraid to go out a little bit longer dated municipal bonds. What other areas should investors be looking for right now?
Well, I think what we're looking for is the solid economic base areas. I think in some ways you have to be selective when it comes to municipal bonds. Some homework is absolutely necessary on that. So in the areas of the country which you think have industrial dislocation, and there are a number of them these days, particularly in the Midwest, you have to be a little more careful if they have been tendency to run deficits and there's excesses of debt in their system. One of the things that is an issue for us right now is the growth in the public pension area as well as their retiree health care. Those are very beneficial to the employees, and they were intended to attract and keep good public servants. But the problem is that some of these are legacy costs where the industries that help to allow for these beneficial programs have gone away. And so what we have to worry about here, can the community with these levels of debt or liabilities through pensions or OPEB, are they able to make those payments? So we're careful about that as we try to decipher it. But there are opportunities. We don't like to generalize. I think that's the important thing. Don't generalize. You can find good bonds in Michigan. You can find good bonds in Ohio and in California and in all other places. But we don't want to go to the other extreme, which was common in the muni market, that takes everything for granted and complacency sits in. That's not a good thing.
What about the notion of distressed municipal debt, debt that has sold off to the extent that it's possible that you could get some capital appreciation as well as still getting a healthy coupon?
I think one of the areas that gives the best example for what you're talking about, Pim, is the area of health care and hospitals. I know hospitals are one of those areas which a lot of people get fearful when they hear the word when it comes to an investment. However, for many hospitals are more or less essential services in their communities, where they are the dominant provider. They have moderate levels of debt that are affordable to them, and they have very strong cash. And even after you look at the losses they took during the downturn, some of those hospitals offer tremendous value, particularly on the long end, anywhere from 5% to 7% yields. And we have found that those are good opportunities for us to be in. And now a lot of institutional market players have thought so too, and we've seen returns on there in the double digits so far this year. And there's still some room there for that area. As the mutual funds came back into the business, back into buying this year, and they have steadily recently as prices improved, what we saw is a lot of hospital bonds being bought because they have a tendency to buy hospital bonds. So prices have been supported in that area.
All right, give you about 30 seconds. I want to know, what about buying bonds, municipal bonds, for out-of-state holders? In other words, let's say you're a resident of the state of New York, look to other states. New Jersey, look to California.
Very good point. We've had this philosophy for years, is that even for our accounts that are on a state where there's tax benefits, we think that diversification is important to them. And we have often found that even for California investors who are in a very high tax bracket, they are better off in maintaining the stability of their account by having a diversified account that goes beyond the state's borders.
All right. I want to thank you very much.
Thank you.
Richard Ciccarone coming in and telling us about municipal bonds from McDonnell Investment Management. Thank you very much.
Thanks for having me.